the entire phony economy that the Fed has helped construct on a foundation of cheap money is imploding. And everything that's been erected on top of it is going to come tumbling down. Nobody can handle normalized interest rates. The government is going to have to level with the people and tell them, you know what, the party's over. We got to either massively raise your taxes or we got to slash spending.
Renowned economist Peter Schiff delivers a stark warning about the fragile state of the global economy. He argues that the phony economy, built on cheap money by the Federal Reserve, is now collapsing, threatening everything constructed atop it. Schiff contends that the government faces a dilemma: either significantly raise taxes or drastically cut spending to address the looming crisis. He challenges the unsustainable spending on Social Security, suggesting tough choices: either reduce benefits or increase taxes on contributors. The Federal Reserve, Schiff asserts, cannot rely on its usual strategy of slashing interest rates due to the escalating inflation. As oil prices surge and stock markets tumble, the situation becomes more dire. Schiff emphasizes the gravity of the situation, explaining how the Fed's previous measures won't work in the current scenario. To unravel the complexities of this economic predicament and discover the shocking truth about what happens next, stay tuned until the end of the video.
We can't keep spending all this money that we don't have. We can't keep giving people Social Security checks because they just take that money and spend it. You know, people on Social Security aren't working, right? They're retired, so they're not producing, but they're spending a lot of money. They're driving up prices. You want to cut back on inflation, you got to take that Social Security money away. Or you got to take money away from somebody else so that people on Social Security can spend it. So either you cut Social Security benefits or you raise the taxes of the people who are paying the Social Security taxes. So you got to raise the payroll tax or you got to cut Social Security. But the politicians don't want to do either one of those. And they didn't have to do anything for years because they could borrow the money instead. And the only reason they could do that was because interest rates were rock bottom. Well, they're not rock bottom anymore. They are normalizing, and they're nowhere near where they're going to go. We still have a long way to go up. People are in denial here. Right? Again, they expect the Fed to cut rates any moment. How can they do that with inflation where it is? You know, by the way, oil was up again today. Oil is back to almost $91 a barrel. And this is with the dollar going up, right? Oil is still going up, and stocks, the Dow is down 400 points today. NASDAQ, an even bigger drop, down about 1.5%, and oil still went up. Imagine what's going to happen to oil if we get a bounce in the stock market. If the dollar falls, oil's going to just go straight up. We're going to go through 100. Oil prices are not going to stop going up because inflation has driven them up. Meanwhile, we can't sell any more oil from the Strategic Petroleum Reserve. In fact, they need to buy oil to refill the reserve. And they're going to have to buy it back at a higher price than they sold. It's going to be a lousy trade. The American public is going to get stuck with a loss. Now, maybe they won't even buy it back for a while. They'll just watch the price go up before they have to try to buy some of that oil back. But you can't cut rates. The markets don't get this. Yes, the Fed slashed rates to zero in 2009. In fact, it slashed from the 1% in 2001 after the financial crisis. It slashed them to zero in 2008, and then again in 2020 with COVID. Everybody expects, okay, the Fed's going to slash rates to zero again. They can't do that this time. The only reason they got away with it is because inflation, the way it's measured, was under 2%. And Powell could say, well, we can print more money, we can do QE to stimulate the economy because we're underneath our inflation target. And since we need to get the inflation rate up to 2%, we can do this because now we kill two birds with one stone. We stimulate the economy, plus we push up the inflation rate so that we can get to our target.
In the next segment, Peter Schiff unveils a dire picture of the global economy. He asserts that the current collapse, rooted in the Federal Reserve's foundation of cheap money, threatens the financial stability built upon it. Schiff highlights the government's dilemma. It must either significantly raise taxes or drastically cut spending. Social Security spending comes under scrutiny, with Schiff advocating tough choices: reduce benefits or increase taxes on contributors. Traditional solutions like cutting interest rates are rendered ineffective due to soaring inflation. Schiff questions the logic behind rising bond prices, emphasizing that excessive supply and inflation fears deter buyers. The strength of the dollar, albeit temporary, is keeping gold prices from soaring. Schiff predicts a future where gold and oil prices rise together, while the dollar and bonds plummet. As the dollar's strength wanes, a slow-motion crash could escalate into a full-scale financial disaster. Schiff's analysis serves as a chilling warning about the imminent challenges the global economy faces. Stay tuned for the critical insights that could safeguard your financial future.
So quantitative easing, stimulus, the Fed conceded that those policies would push the inflation rate up because that's what they claimed they wanted. They wanted higher inflation. So that was the justification. But if we have a crisis now, if the markets crash and if banks start failing, but the inflation doesn't come down, how do you justify cutting rates? You can't, because inflation is too high. You can't say, well, inflation is 4 or 5%, but we're going to create even more of it to try to prop things up. That will just crash the dollar, send prices ballistic. In fact, I think that at some point soon, that's going to happen anyway. I mean, right now, the dollar is rising because bonds are getting killed. Why? Why should that be? Just because long-term interest rates are going up. That's not bullish for the dollar. I don't know if these algorithms have been programmed right to understand this. The reason that bond prices are falling is because people don't want to buy them, right? There's too much supply and not enough demand. People don't want U.S. Treasuries. Well, if they don't want U.S. Treasuries, they shouldn't want U.S. dollars either, because that's what U.S. Treasuries are. They're future payments of U.S. dollars. And also, the reason that people don't want these bonds is because they can see all the inflation that is being created. Maybe they looked at the national debt clock and moved it up to 2027 and freaked out, right? The bond vigilantes that have been asleep for decades, they're like Rip Van Winkle, finally waking up, to reality, and they're selling their bonds. Well, everything that makes bonds unattractive makes the dollar unattractive. If you're selling your bonds because you're worried about inflation, because the government's going to have to print a lot of money to monetize all this debt, why would you want to buy the dollar? No, you don't want the dollar. You want to get rid of the dollar. This is going to happen. But the strength of the dollar is keeping gold from exploding. That's why gold is $1,900. Gold was down about 10, 12 bucks today. It should be a lot higher than 2,000, and it will be once the markets come to their senses. Gold should be going up with oil. Right? Oil is black gold. Gold is yellow gold. They should both be going up. They normally have more of a positive correlation. Eventually, gold and oil are going to trade in the same direction. And the dollar and bonds are going to trade in the same direction, down. The dollar should be falling. And when the dollar is falling, that is going to accelerate this problem. The fact that the dollar is rising is cushioning the blow right now. Things will be a lot worse once the dollar starts to fall, especially for the bond market. Once people start dumping their bonds and their dollars, then we're going to see this slow motion crash turn into a normal motion crash. And so far, even the weakness in the stock market is not helping the bond market. Imagine all these people that bought bonds because they thought they were going to hedge their stock portfolio with bonds. And they're actually losing more in bonds than in stocks, but they're losing in both.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, Take care and invest wisely.